Welcome to Iron Financial. This is where we forge stronger portfolios by cutting through all the market weakness. And today, we are putting MicroStrategy under the microscope. Now look, this isn't just going to be another stock analysis. You can get that anywhere. Think of this as a structural stress test. For anyone out there with serious capital at play, understanding the architecture of this company, how it's actually built, is absolutely non-negotiable. That's exactly right, because before we even look at a single number on a spreadsheet, we have to ask a really fundamental question. What is MicroStrategy anymore? Is it the boring, legacy enterprise software company that it still claims to be? Or is that whole operation just a shell for something else entirely? A massive, high-stakes leveraged bet on a single, extremely volatile digital asset? We're here to figure out if this thing is a fortress built to last or just a well-disguised facade. Okay, let's just start with the number that completely defines this entire story. As of February 1st, 2026, MicroStrategy holds 713,502 Bitcoin. Let that sink in for a second. At today's prices, that is a treasury worth tens and tens of billions of dollars. This isn't just part of their strategy, it has become the central pillar of the entire operation. Everything else revolves around this number. And that number brings us right back to this identity crisis. The company's own press release calls itself the world's first Bitcoin treasury company, okay? They're telling you what they are. And yet, for all official purposes, it still operates and reports as an enterprise software business. So which one is it? You have to ask yourself, is the software business just a piggy bank to fund the Bitcoin addiction? Or is the Bitcoin treasury the real engine here, with the software side just kind of chugging along in the background? It's a really crucial distinction because as an investor, you have to know what you're actually buying. Are you buying a tech company that has a novel, maybe interesting treasury strategy? Or are you buying a de facto Bitcoin fund that just happens to sell some software on the side? The risk profile between those two things is night and day. And that is exactly what we are here to determine. So here is our blueprint for today's analysis. First up, we're going to keep dissecting this dual identity. Then, we are going to hammer into the financials, and you'll see the stark contrast between their operational reality and their Bitcoin-driven paper losses. After that, we'll examine the incredible machinery they've built to forge this Bitcoin treasury. Next, and this is critical, we need to decode their new math, the custom metrics they literally invented to justify this whole strategy. Then, we'll look at the ultimate gamble, the leveraged financial products the market has built on top of MicroStrategy itself. And finally, we will render our verdict. Is this a digital fortress or a house of cards? Let's get to work. All right, let's get right into our first section, a tale of two financials. This is where we really look at the stark difference between the company's actual revenue and the immense, almost unbelievable volatility on its books. We're going to start by just establishing a baseline from the Q4 2025 earnings report. We're talking about the actual operating business here. What is the software side of the house actually bringing in? Okay, so in the fourth quarter of 2025, their total revenues came in at just under $123 million. That's about a 1.9% increase year over year. It's not explosive growth by any means, but it's stable. This is the bedrock. It's the predictable, if a little unexciting cash flow they get from selling AI-powered enterprise analytics software. You can think of this as the solid, concrete foundation of the entire building. In any normal company, this would be the headline number, but at MicroStrategy, it's barely even a footnote. A footnote is right, because how on earth do you reconcile a $123 million revenue stream with this number, an operating loss of $17.4 billion, in the same quarter? No, that's not a typo. That is billion with a B. This isn't just a crack in the foundation. This looks like a sinkhole just swallowed the entire construction site. How is this even possible? A company doesn't lose 140 times its revenue in a single quarter from selling software. There's something else going on here, and it's a massive, flashing red flag for anyone just looking at the surface-level numbers. And this is the complete disconnect. That $17.4 billion loss has almost nothing to do with the software business. It's a direct result of a brand new accounting rule, fair value accounting for digital assets. See, before this, it was strange. They could only write down the value of their Bitcoin when the price fell, but they could never write it back up. Now, they have to mark their entire Bitcoin stack to its current market price every single quarter. So if the price of Bitcoin happens to drop during that 3-month period, they have to report that drop as a loss on their income statement, even if they haven't sold a single Satoshi. It's what we call a paper loss, but it's one that creates absolutely incredible volatility in the reported earnings. And you can see it with your own eyes right here on their actual consolidated statement of operations. Just look at the top. Total revenues, 123 million, okay? Then gross profit, 81 million. Then you see the normal operating expenses, sales and marketing, R&D, admin, all totally normal-looking figures. But then you hit this one line item I've highlighted, unrealized loss on digital assets net. And there it is, over $17.4 billion. This single line item just completely overwhelms everything else on the entire income statement. So the crucial point here is this. When you strip out this accounting artifact, the core software business is just chugging along. But the headline number, that net loss of $12.4 billion, is dictated entirely by what the price of Bitcoin did in that specific quarter. Okay, so the losses are paper losses based on some new accounting rules. I get it. But the Bitcoin itself is very real. And they keep buying more. I mean, they acquired over 41,000 more Bitcoins in January 2026 alone. Now, their software business we just saw is not generating nearly enough cash for that kind of shopping spree. So where is all this money coming from? They're clearly not just using profits to build this fortress. They must be using some really heavy-duty financial machinery. What is it? Well, the CEO, Feng Li, he lays it out right here for us. $25.3 billion raised in a single year. And get this, they were the largest equity issuer among all U.S. public companies for a second consecutive year. Just let that sink in for a minute. A mid-sized software company is outraising the absolute giants of the market. This isn't a side project anymore. This is a full-scale capital markets operation. They have fundamentally transformed the company into a machine that is designed for one primary purpose, to acquire capital from the markets and immediately convert it into Bitcoin. The scale is just staggering. And here's a look inside the engine room. This is how they do all that heavy lifting. The biggest tool in their toolbox is their at-the-market, or ATM, common stock program. That's where they sold $4.4 billion worth of their stock directly into the market in Q4 alone. But that's just one piece of the puzzle. As you can see, they've also created this incredibly complex web of preferred stocks, each with its own ticker and yield. STRK, STRF, STRC. These are basically IPOs of perpetual preferred stock, and they're raising billions more. It is a very sophisticated machine designed to do one thing, vacuum up capital, right? But is it sophisticated or is it just dangerously complex? To me, this looks less like a fortress and more like a high-rise built with a dozen different kinds of experimental materials. You've got constant dilution of common shareholders from that ATM program. Then you have this absolute mountain of preferred stock, which is senior to common stock, and it's all demanding these hefty dividend payments in perpetuity. We're talking dividend rates of 8%, 10%, even a variable rate on STRC that's now over 11%. Servicing all of this requires a massive, constant outflow of cash. So is this structure truly resilient, or could the whole thing just collapse if Bitcoin has a prolonged, nasty downturn? Well, management clearly believes it's resilient. The CFO, Andrew Kang, he states it unequivocally right here. Strategy's capital structure is stronger and more resilient today than ever before. And their argument is that they've built up a USD reserve of $2.25 billion, specifically to cover over 2.5 years of these exact dividend and interest payments. So from their perspective, they have engineered a structure that can withstand volatility, and they're very confident that they've stress-tested this design. Which brings us to a really crucial part of their story. See, to measure a strategy this unique, traditional metrics like PE ratios, they just don't apply. They're useless here. So MicroStrategy created their own. This brings us to our next section, decoding the new math. If you are going to even think about investing in this company, you have to speak their language, and you have to understand the key performance indicators, the KPIs that they themselves use to grade their own performance. So the cornerstone metric is something called Bitcoin per share, or BPS. This is the North Star for the entire company. The calculation itself is pretty simple. They just take their total Bitcoin holdings and they divide it by the total number of potentially outstanding shares of the company. The goal, the only goal really, is to make this number go up. Every single capital raise, every financial decision they make is judged against one simple question. Is this transaction accretive to BPS? In their view, if they can increase the amount of Bitcoin backing each share of stock, they are creating value for the common shareholder, regardless of what that crazy income statement says. And this next metric is how they measure their success in growing that core number. BTC yield is simply the percentage growth in BPS over a given period. And for the full fiscal year of 2025, they are highlighting a BTC yield of 22.8%. Now, from their perspective, this is a massive win. It means their financial engineering, issuing stock and debt to buy Bitcoin, was done so effectively that each share of MSTR now represents 22.8% more Bitcoin than it did at the start of the year. In their world, this is the true measure of performance. Whoa, hold on a minute. This quote right here, this is from their own financial report. They are explicitly telling investors that these custom-made metrics are not measures of financial performance. That is a massive disclaimer. They're basically saying, hey, here are the numbers we really want you to focus on. But just so you know, they don't actually reflect the financial reality or the value or the liquidity of the company. To me, this is a huge, huge red flag. Are these KPIs actually providing clarity, or are they just a clever way to distract everyone from the massive risks, the dilutive capital raises, and the real-world financial obligations they've taken on? It really seems like they want to be graded on a test that they wrote themselves. And speaking of risk, if you think MicroStrategy stock itself is volatile, well, the market has gone and created something even more extreme. Let's talk about the derivatives that have been built on top of this already high-stakes gamble. This is where the theory really meets the pavement, and we can see how professional market participants are packaging and selling the risk that is inherent in this company. This takes all the volatility we've been talking about and just cranks it into overdrive. So what you're looking at here is a key information document for an exchange-traded product, or ETP, from a company called Leverage Shares. And the product is simple and it is brutal. It aims to deliver 3 times the daily performance of MicroStrategy stock. So if MSTR stock goes up 5% in a single day, this product is designed to go up 15%, minus fees and costs. But, and this is the crucial part, if MSTR goes down 5%, this product is designed to fall 15%. This is a financial high-wire act, and there is no safety net. And the regulators, they absolutely agree. European law requires these documents to include a summary risk indicator. Now look at this. The risk is rated 7 out of 7. It is literally the highest possible risk class they can assign to a financial product. The document flatly states this rates the potential losses from future performance at a very high level. Now, this isn't just our opinion. This is the official, legally required warning. They are telling you straight up that this is one of the absolute riskiest public market products you can possibly buy. And what's really interesting here is the recommended holding period you see, 1 day. Now, that's not just a friendly suggestion. It's a structural warning. Because these leveraged products rebalance every single day, they suffer from something called compounding effect or volatility decay. What that means is if you hold this for more than a day, your returns can deviate wildly from 3 times the performance of the underlying stock. On a stock as volatile as MSTR, holding this for a week or a month during choppy price action could absolutely destroy your capital, even if the stock ends up right back where it started. This product is explicitly built for day traders, not for investors. But this is the slide that says it all. The document is required to show these performance scenarios, and I want you to look at the one line I've highlighted, the stress scenario. It shows what you might get back in extreme market circumstances after just 1 day. If you invest $10,000, your potential return is 0, a percentage loss of negative 100%. Now, this isn't some theoretical, far-off risk. They are telling you, right there in black and white, that it is entirely possible to lose every single dollar you invest in a single trading session. This just demonstrates the knife-edge volatility that underpins not just this product, but the underlying stock itself. Okay, let's pull all of these threads together for our final section, the verdict. We've examined the dual identity, we've looked at the shocking financials, the complex capital raising machine, the custom metrics they use, and the extreme speculative instruments that trade on top of it. It all really comes down to the 2 metaphors that we started this whole thing with. So on the bull side, the argument is this: management has built a digital fortress. They've used their stock as an incredibly powerful tool to acquire over 700,000 Bitcoin, creating a treasury of a scale that is just unprecedented. They've engineered a complex but, in their view, resilient capital structure with a large cash reserve to weather any storms. And they measure their success by Bitcoin per share. And by that metric, they've generated a 22.8% yield for their shareholders last year. For the bulls, MicroStrategy is simply the best way to get leveraged, accretive exposure to Bitcoin inside the traditional financial system. The bear case, however, sees a house of cards. The foundation, that software business, is just way too small to support the colossal weight of the Bitcoin treasury that's been built on top of it. The structure is held together by this dangerously complex web of debt and preferred stock that requires hundreds of millions of dollars in annual payments. The headline losses are absolutely staggering, even if they are just on paper for now. And the extreme risk is validated by the very existence of products like that 3x ETP, which explicitly warn that a 100% loss in a single day is a possible outcome. The bears argue the entire edifice is just precariously balanced on the price of a single, notoriously volatile asset. And ultimately, that is the multi-billion-dollar question, isn't it? We've laid out the blueprints for you, we've inspected the materials, and we've shown you the results of the market stress tests. So is this a visionary financial fortress engineered for a new digital age? Or is it an over-leveraged, incredibly complex gamble whose structural integrity has yet to face a true, brutal crypto winter? The final verdict? That's up to you. You have the data. It's your portfolio. Forge it wisely.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.